Hello folks, Steve Lentz here with Discover Options. Welcome to the Prepared Mind. This is the Prepared Mind entry for July 1st. That was a Friday. Of course, we have the holiday, and the first trading day after this will be on Tuesday, July 5th. We have two reports for you today. The S&P 500 Condor Butterfly Timing Report, followed by the S&P 500 Directional Likelihood Report. Now, we'd love for you to subscribe and get updates as to when we come out with new entries here for our channel. If you could subscribe, just go to the button below. We'd love for you to routinely get alerted to every time we post something here. Also, before we get to the reports, you should know that this is the a video entry for the Prepared Mind. Frank Fahey does a wonderful text version of the Prepared Mind on our blog page. Go to discoveroptions.com, click the blog link there, and that'll take you to his entry. He has several bits of information, including a list of double calendar candidates for earnings reports. This is primarily meant for sophisticated options traders, and some great information with Frank. He's one of our mentors and manages several accounts as well. Finally, before we get to the reports, you can click on the link the above right, and that'll take you to the page to get information on receiving a free ebook, Simple Steps to Options Trading Success, co-authored by myself and Jim Graham. All right, on to the reports. First, we'll have the Butterfly and Condor Timing Report. For those of you that are selling premium in a market-neutral fashion, kind of range trading, so to speak, a lot of folks like to do this from the perspective of getting routine monthly income. And we're trying to take it to the next level, where we're trying to time the entries on these income-type trades and make it a more refined entry point, rather than saying, the third Thursday or the fourth Friday, or whatever you want to think of in terms of a seasonal entry. We try and time it looking at price action a little bit as well. All right, so let's go to it. I'm going to show you why we need to look at this timing report, the methodology behind it, and then we're going to get to the actual current condition and what edge level we have given Friday's close. All right, so here's an example, just showing you why you may want to look at the, timing the entries of your condors and butterflies. If you were sitting there December 31st of 15, the market had begun to trade in a range, but by using some methodology, some technicals, we could ascertain that this probably was not a good time to enter a condor and butterfly position. In fact, if you ran it through our algorithms, we would have had a negative edge of 4.2. Now, what this told us at the time was that there was a higher than usual likelihood that the market would be more volatile than what was being implied at the time by the option prices. Now, how do we know that? Well, I'm going to show you in a little bit, but suffice to say, there was a negative edge being reported at that time. What did the market do at that point in this particular case? Well, it became very, very difficult to maintain a condor and butterfly type position without doing some extreme adjustments, and eventually perhaps getting out completely with a loss. That's just one example, and it's understood. We look at the examples that are the most obvious. Most examples, though, in real life are more subtle, but I think you get the picture. Here's the current market condition as of July 1st. All right, we like to look at this, and we're going to then try and ascertain whether this condition is a good one for selling premium. The price action, Thursday was an upswing day, higher high, higher low. Friday was another upswing day that's colored in red with a higher high and a higher low. We're above the 50-day simple moving average. In terms of stochastics, the 15.3, we're above 50 and below 90, so we're getting into the overbought region a little bit there, and we're above the 3-day moving average. So it's definitely on the bullish side, getting into the overbought region as we speak at around 80 or so. One thing of note that I wanted to throw in here in terms of our current market condition is Friday was a very narrow range day. And in terms of the percentage, our ATR, a single day average true range, turned out to be 0.008, not even 1%. That's very low. So what I wanted to do is include that in the market condition, and that Friday, after all this ups, moving up like this, well, now we had a very small range on Friday, and that's a unique condition. So we're going to go back in time. The question here is this current condition a good one for selling option premium through range trading, condors and butters? Okay, so how do we ascertain that? Here's the methodology. First, we need to look at the actual move from a given close and understand what the actual moves are, and we measure that. For example, here we have a close of 2076, and over the course of the next 21 days, 21 bars, how far did the market move max, either up or down? Well, in this case, it ended up moving 50 points to the downside. That was the maximum move over the course of the next 21 days. We then measured that to about a 2.4% is what it turns out to be. And indeed, down there in that little indicator window, you'll see 2.4% appears for that particular day. So we can measure the actual move. Now, here's the question. What was the move implied by the option prices? What market move was being implied by the option prices at the time? Remember, we're trying to figure out a way to time the entries here, and it's important that we're able to determine whether a bar was favorable or unfavorable. In this case, the option prices were implying a 4.4% move. The market actually ended up moving 2.4%. So when you break it down, that bar turns out to have been favorable for selling premium. You would have sold options at a 4.4% implied volatility, yet the market only moved 2.4%. So that was a favorable, and what we would do is paint the bars blue in that case. We paint them blue, and then we paint the ones that are unfavorable would be red. Those where the market moved more than what was being implied. Okay, so we have blue and red bars. Now, with the ones on the far right, 21 days has not yet gone by. We can't really paint those blue or red. We just don't know yet. So we're looking in hindsight whether a bar was blue or red. Here's what we do. We measure the percentage historically as to the number of bars, the percentage of bars that were favorable or unfavorable. And then once we know that, we look at the bars that match our current market condition. Which, if I showed you that, remember that when I showed you that before? What our current market condition was, we're above the 50-day and 2 upswing days and all that. Well, that's happened roughly 72 times, between 72 and 80 times in the past, going back to January of 80. Of the bars that match our current market condition, what percentage of those were historically favorable for selling premium? How many of those 80 were blue bars? Okay, and is that percentage of blue bar, is that percentage higher than the historical? So let's look at the historical first here. How many, just on average, are blue? And when you break it down, you go back to January of 2000, 64.7% of all the bars turned out to be favorable for selling premium. Okay, roughly 2/3, 1/3. Okay, 35.3% were unfavorable. So that's the benchmark. Okay, that's the benchmark. Roughly a little over 1/3 of the time you put on a condor and butter, if you did it randomly, just flip a coin, pick a day, roughly 1/3 of the time you're going to be in choppy waters needing to make adjustments or get out for a loss, or perhaps both. 1/3, or excuse me, approximately almost 2/3 of the time it'll be smoother sailing. Maybe you have to make an adjustment, but all in all, the market's going to move less than what was being implied by the option prices. All right, so that's the breakdown historically. Now, of the bars that match our current market condition, what percentage of those were historically favorable for selling premium? Here you can see, going back to, the current market condition we have as of Friday, inclusive of that average true range aspect, that's only happened 4 times in the last year. Okay, it doesn't happen that often. But when it does, what happens typically? Is it blue or red? Listen, here's the way it breaks down. Of those 80 going in the past, of the 80 bars, 68.7 are favorable, 31.3 are unfavorable. That's just a little bit better than historical. We have roughly a 4% edge over the historical breakdown. So 68.7% of the current market condition bars are favorable. Historically, it's 64.7. So there's a little bit of an edge, as you can see here, okay? So if those of you that are into butters and condors, range trading, okay, right now the environment is better than a coin toss for getting in, at least if you look at the history. Doesn't mean you're not going to get choppy waters. You still got 31.3% that are, but at least that's lower than the historical number. Okay? All right, so that is that report. Little bit of a thumbs up for selling premium neutrally given the history. Let's look now at the likelihood that the S&P is going to go up, down, or wobble in the middle. Okay, and not do anything. Let's go take a look at that. But before we do, I want to make sure you understand at discoveroptions.com, we have one-on-one mentoring services spanning an introduction to options for the beginner, covered calls, puts and collars, if you want to dip your toe in the water, see what we're all about. If you trade earnings, we have a wonderful earnings announcement course for trading options on earnings using calendars and straddles and that. Finally, we also have a full-blown equity track where we will take you from A to Z in terms of learning options, directional spreads, range trading with condors and butters, making adjustments, and all that stuff. That's a 14-week course. 14 sessions with a one-on-one mentor. And also those of you trading futures options, we have a wonderful futures track as well with Paul Forcioni to help you out in the one-on-one mentoring there. So if you're interested at all, take a look at the website, give us a call, and we'll walk you through the best program for you. Directional likelihood. Which way is the market going to go? Well, let's go take a peek here. Here's our current market condition. And the question is since January of 2000, how often has this occurred, the same condition, and what direction did the market go from here? Did it go up, down, or kind of wobble around and trade in a range? Well, let's go take a look how we do this. Here's our methodology. We need to understand the historical distribution of price. So instead of looking at the past and using a stop loss to determine a trading system, what I like to do is just to look at the way price was distributed after a given technical setup. But first I want to know how price is distributed from every close. Okay? Just what's the benchmark distribution of price from any given close. After that, I look at the distribution after a specific condition, and then we compare the two. So how do we determine distribution of price? Here's our methodology. I look at volatility bands. I set these one standard deviation apart out from the close. I use a 20-day historical volatility number, and I distribute those log normally. And I do this in 3 different time frames, 5, 10, and 15 days. So here's an example of a 10-day band. You have the close, and then you have a 10-day band set up here, and a 10-day band set down here. And we're using the 20-day historical volatility to determine how far up and down we are. Here's the question. From this close, will price hit the upper band, go down and hit the lower band, or wobble around and stay in the middle? Okay, let's see what happened in this particular case. Boom. It went up and hit the upper band. So for that particular close, we record that the market hit the upper band for that particular close. Then we look at this close. We have the band up here, the band down here. The question is, in this particular case, did the market go up and hit the upper, the lower, or wobble in the middle? Upper, down over the next 10 days, or did it wobble in the middle here? Let's go take a peek. What did it do? It hit neither of them. If you look real close, did the market go down and hit that one? No, close but no cigar. So for that particular close, we record that it hit neither of them. Okay, so we do this for all the closes. We record how often price struck the upper and lower 5, 10, and 15-day bands. And when you break it down since January of 2000 through July 1st, price hits the upper band roughly 29.5% of the time. This is over 4,100 incidences. It hits the upper 10-day band roughly 23% of the time, 15-day upper band 23% of the time approximately. It hits the lower band roughly 30% of the time. You can see those lower 10-day band 29.6, lower 15 32.4. So this is the distribution of price in 5, 10, and 15-day increments. Now, you see where we're headed with this? We're going to take a look at a certain technical scenario, the one we have going on as of Friday's close. And we're going to go see what the distribution of price was as of that date, or for that condition going back. And here when I ran this, it were roughly 72 signals that I received. You can see there's 4 of these going back this year. And what I'm going to do is look at the distribution as of the close, the distribution if price goes above the high of Friday, and if it goes below the low of Friday. Okay, what is the distribution if it goes above the high or below the low? And then what's the baseline at the close? This way, that gives us a game plan for expectations on as of Tuesday's open and proceeding through the day. So here we are. If, as of the close Friday, there were 72 signals, and of those 72, look at this, price hit the upper band. Of those 72, price hit the upper band 11.1% of the time, which is 18% less than the historical distribution. So it looks like it hits all 6 of these bands less often than the historical distribution. So this is telling us that as of the close on Friday, for those 72 signals, we would expect price to not hit the bands near as often as normal. We would expect lower volatility levels in general. Okay, it doesn't mean it's guaranteed. We could have that 1 time in 10, it flies off and hits them, as you can see here. What the how often it hits these. Well, it's a little more than 1 time in 10, 1 time in up to 1 time in 20. Or so. So anyway, but it's telling us that there is a greater than normal likelihood price will be less volatile than normal moving in the future. Okay, let's go and look at what if price goes above the high of Friday. If it goes above the high of Friday, we still see all 6 bands, okay, are being hit less often by quite a bit. It's hitting those bands 14, 12, 10%. 8, 16, 12%. Not very often. Finally, what if it descends below the low on Friday? Now it's hitting the bands. 4 of the bands get struck a little bit more often. 4 of the bands get struck a little bit more often, 2 of them a little bit less. So if it goes below the low on Friday, we would expect more volatility than what there has historically been. If it goes above the high of Friday, then it would, oh, and by the way, this should say Tuesday. If on Tuesday, copy and paste, drives us crazy, right? Okay, so that gives us a little bit of a game plan. Now, one thing I like to do is go to the, I like to recast the bands using a skew adjusted VIX figure. Okay, so that the upside bands, 5, 10, and 15-day bands on the upside, we're using a lower volatility because, if you look at the options, the vertical skew works out so that the upside typically has a lower volatility than the downside. Those out-of-the-money puts have a much higher implied volatility than the out-of-the-money calls. And we're reflecting that in the way we cast these bands. Now, because the VIX is typically higher than a 20-day historical volatility, okay, the VIX band, these bands are farther out, and hence they get struck a little bit less often. Instead of 23 to 30%, we're now down here roughly 15% to 20. So the VIX, skew-adjusted VIX bands are farther away, getting struck less often. But when we still run this analysis, we could see that as of the close, these VIX bands are getting struck less often than normal by just a little bit in this particular case. If it goes above Friday's high, again, getting struck less often, less volatility. And then if it goes below the low on Friday, we can see that 3 of the 6 bands are getting struck just barely a little bit more often. So kind of same pattern going on here. All right. One thing I wanted to do, and I kind of got here, let me get rid of this. Boom, there we go. If you look at the skew-adjusted VIX volatility, the downside volatility is at 16.9. The upside's at 12.7. If we were to recommend a trade right now, or at least give you an idea to consider, I would use that downside volatility number to define the 1 standard deviation level in the puts. So let's just look at an idea here, an offset put butterfly. Okay, and I'm just showing you here that we can look at the VIX in black. I came up with a skew-adjusted downside VIX, which is at 16.9. The upside VIX is at 12.7. Let's take that 16.9 number. Let's plug it into option view up here into the SV box. That defines our 1 standard deviation level right here. And let's set up an offset put butterfly such that if the market were to go up, we would still make money between now and expiration. So what way we work this is we buy an at-the-money put. We sell twice as many going out towards a half a standard deviation or a little bit less. But we want to make sure that if we sell 2 at this price, we're collecting far more than what we're spending for the at-the-money. And we want to have enough left over so we can go pretty far out of the money and spend that money such that our net cash flow is going to be pretty darn close to 0. So if the market goes up, we shouldn't lose any, really very much money at all if it does go up to the upside. Now when we analyze this is what's nice here, is that you can see here, no matter how far the market goes up, we're not going to lose very much money at expiration, but we do have to manage the downside. And what I did is I pointed out, this is as of Friday's close, T plus 17, we're at the midline here, right here. Look at the yields 17 days in the future. If price stays within that 1 standard deviation, we could make a pretty good yield in 17 days. I mean, you're not going to make double and triple your money like you could doing other kinds of speculative trading, speculative directional things. But at least here, no matter which way the market goes, if it stays within a 1 standard deviation level, then we should be able to make, a decent profit here. Okay, so that's just one idea. When you get into option view, you can play around with that. That's an offset put butterfly. And I'll tell you what, the price chart, when you use that little birdie button up there, right up here, this little profit and loss button, gives just a real nice little profit area. If price were to channel around at all after the big volatility we've had the last week, well, then it should mean some decent money moving in the future. Okay, so that's the trade idea we have for you here today. Folks, I sure appreciate you joining us. Hope you subscribe or give us a call or do both. Love to hear from you and tell you a little bit more about what we have to offer at Discover Options. Thank you very much. We'll see you next week. Bye-bye.